passive income through dividend investing is one of the most misunderstood paths in the market, because people hear the phrase passive income and imagine effort disappearing while money quietly arrives. When in reality, dividend investing demands a different kind of discipline, patience, and realism than almost any other approach I've practiced over the years. I learned this not from theory, but from living through cycles, where dividends felt like a blessing, and cycles where they revealed their fragility, and the difference between disappointment and durability always came down to whether I understood what dividends really are and what they are not. The first mental reset you need is this: dividends are not free money. They are a distribution of capital that already belongs to you as a shareholder. When a company pays a dividend, its stock price adjusts accordingly. The value does not magically appear, it is transferred. Beginners who don't grasp this chase high yields without understanding the business underneath, and that is how dividend investing turns into a slow-motion value trap. The real benefit of dividends is not the payment itself. It is what consistent payments reveal about the quality, stability, and cash-generating ability of a business over time. Early in my career, I made the classic mistake of yield chasing. I sorted lists by dividend yield, bought what looked generous, and felt smart when cash hit my account. Then the cycle turned. Companies with the highest yields were often the ones under the most stress. Payouts were cut, prices collapsed. What I thought was passive income turned out to be capital destruction with a small monthly consolation prize. That experience taught me a lesson I never forgot in dividend investing. Safety comes before yield always. A sustainable dividend begins with cash flow, not profit. Accounting profits can be adjusted. Cash cannot. The first question I now ask is whether the company consistently generates free cash flow after maintaining its business. If dividends are paid out of debt asset sales or hope they are not income, they are liquidation. Dividend investing only works when the business itself is boringly productive, producing excess cash year after year without heroic assumptions. The second pillar is payout discipline. A company that pays out too much of its cash flow leaves itself no room to adapt. Economic downturns, regulatory changes, cost pressures, these things happen. When payout ratios are stretched, dividends become vulnerable at exactly the moment investors rely on them most. I learned to favor companies that could pay more but choose not to, rather than companies that pay everything they can to attract attention. Restraint is a form of strength in dividend investing. Consistency matters more than generosity. A moderate dividend that grows slowly over decades compounds far more reliably than a high dividend that fluctuates or disappears. This is why dividend growth matters. Companies that raise dividends steadily are telling you something important. Management is confident not just about this year, but about cash flows well into the future. Those increases also help offset inflation, which silently erodes fixed income streams over time. Without growth, passive income becomes passive stagnation. Another critical lesson is that dividend investing is not immune to volatility. Dividend stocks fall in bear markets. Sometimes they fall hard. The difference is psychological and structural, not mathematical. When income continues to arrive during drawdowns, it becomes easier to hold rebalance and stay rational. Dividends don't eliminate drawdowns. They change how drawdowns feel, and that change in behavior is where much of their real value lies. Dividend investing also forces you to think like an owner rather than a trader. You stop asking, "Will this go up next week?" and start asking, "Will this business still be paying me 10 years from now?" That shift slows decisions and filters noise automatically. Over time, I noticed that my best dividend holdings were the ones I rarely thought about, not because they were irrelevant, but because they were doing exactly what they were supposed to do without drama. Diversification plays a unique role in dividend strategies. Relying on a single company or sector for income is dangerous. Industries go through cycles. Regulations change. Business models break. A resilient income portfolio spreads dividends across sectors, geographies, and payout profiles so that no single cut derails the entire plan. Passive income only feels passive when the structure underneath is robust. ETFs taught me to respect this structure deeply. Dividend-focused ETFs diversify away single company risk and smooth income streams. They are not perfect, and they are not immune to cuts, but they reduce the impact of any one failure. For many investors, especially early on, ETFs are the most sensible way to build dividend income while learning how businesses behave across cycles. Individual stock selection can come later when experience earns it. One of the hardest truths about dividend investing is patience. It works best when you don't need the income immediately. Reinvesting dividends early allows compounding to do its work quietly. Pulling income too soon often starves the portfolio before it matures. I've seen investors sabotage good dividend strategies by demanding income before the base was strong enough to support it. Income investing is not about extracting value early. It is about building capacity first. Over decades, I came to see dividend investing not as a separate strategy, but as a behavioral framework. It rewards conservatism, long-term thinking, and humility. It punishes shortcuts, yield obsession, and impatience. When done correctly, it doesn't make headlines, but it builds something far more valuable: reliability. And this is where we need to continue next, because understanding what dividend investing is conceptually is only the first step. The real confidence comes from knowing how to build a dividend income portfolio deliberately, how to choose between dividend stocks and dividend ETFs, how to evaluate payout safety, how to reinvest versus withdraw, and how to align income strategies with different life stages, so that passive income becomes a sustainable outcome rather than a marketing slogan. And that transition from philosophy into practical structure is exactly where we go next. As this sentence carries forward into laying out a simple, beginner-friendly framework for building dividend income the right way, without yield, chasing without false security, and without sacrificing long-term capital in the process, by turning dividend investing into a system rather than a collection of high-yield tickers. Because income only feels passive when the structure underneath it has been designed to survive bad years as well as good ones. The first practical decision you must make is whether dividends are currently a growth engine or an income engine for you. Early on, dividends should almost always be reinvested. This is the phase where income is not for spending, it is for compounding. Reinvested dividends buy more shares, which generate more dividends, which buy more shares again. And that quiet loop is where most long-term dividend success actually comes from. Pulling cash out too early feels rewarding, but it slows the engine before it has enough momentum. Once that role is clear, the next step is deciding how you want to access dividends through individual stocks, ETFs, or a combination of both. For most beginners, dividend ETFs are the smarter foundation. They provide instant diversification across dozens or hundreds of dividend payers, reduce single company risk, and smooth income streams. You trade some upside for resilience, and resilience is exactly what you need while learning. Individual dividend stocks can be layered in later once you understand payout cycles, sector risks, and how dividend cuts actually unfold in real markets rather than spreadsheets. When evaluating dividend payers, I use a very simple safety framework. First, I check free cash flow coverage. Dividends should be comfortably covered by free cash flow over multiple years, not just one strong period. Second, I look at payout ratio trends, not the absolute number. A stable or declining payout ratio tells me management is leaving room for uncertainty. Third, I look at dividend history, not just yield. Companies that maintained or modestly grew dividends through recessions earn trust. Those that cut aggressively when conditions tighten should be treated cautiously, no matter how attractive the current yield looks. Sector balance matters enormously in dividend portfolios. Beginners often overweight traditional high-yield sectors like utilities, telecoms, or energy, believing yield equals safety. In reality, these sectors carry their own risks: regulation, capital intensity, commodity exposure. A durable dividend portfolio spreads income sources across sectors with different drivers: consumer staples, healthcare, industrials, financials, infrastructure, and selectively technology. The goal is not equal weighting, but independence of risk. When one sector struggles, others should be able to carry the income load. Geographic diversification is another overlooked layer. Dividend cycles differ by country and region. Relying entirely on one market ties your income to one economic and regulatory system. Global dividend ETFs, or selective international exposure, can reduce this dependency. Again, this is not about chasing higher yields abroad. It is about spreading structural risk. So one policy change or recession does not disrupt your entire income stream. As your portfolio grows, rebalancing becomes part of income management. Dividends reinvested unevenly can distort allocation over time. Periodic review ensures no single stock or ETF becomes an outsized income dependency. This is especially important once you transition from reinvestment to withdrawal. At that stage, income stability matters more than growth, and pruning weaker dividend payers early prevents painful cuts. Later, when you rely on the cash, the transition from accumulation to income is where many dividend investors stumble. This shift should be gradual, not sudden. You don't wake up one day and turn off reinvestment across the portfolio. You phase it. Some dividends are taken as income, others still reinvested. This maintains growth while funding lifestyle needs. Done correctly, your portfolio continues to strengthen even as it starts supporting you. Perhaps the most important discipline of dividend investing is accepting that dividends will not always increase smoothly. Cuts happen. Freezes happen. Markets change. The goal is not to avoid every cut, but to ensure no single cut breaks the system. This is where diversification, payout discipline, and conservative assumptions prove their worth. Income investing is not about certainty, it is about resilience. Looking back, the dividend strategies that worked best for me were the ones I rarely touched. No constant optimization, no yield chasing, just steady accumulation, disciplined review, and patience. The income grew not because I was clever, but because the structure was sound enough to let time do the work. That is the real promise of dividend investing done right. Not excitement, not shortcuts. Reliability built slowly, deliberately, and with humility. If this framework resonated with you, I invite you to subscribe to the channel so we can continue building income strategies that survive real markets, and leave a comment, sharing whether you are currently in the accumulation phase or the income phase, because clarity about where you are today determines how dividends should be used. Sized and respected, so they serve your future rather than tempt your impatience right now.